Hello again, everyone. It is 8 o'clock in the morning, Chicago time, on Tuesday, April 4th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially through the first half of 2023. Let's follow the money. In our previous Your Daily 5 that we did on 3/7, almost exactly 1 month ago, we said that S&P 500 stocks were at a major decision point, but leaning higher. That major decision point was at 3,900 in the S&P 500, major underlying support, and SPX has risen by 4% since then. So let's take this forward and look at number 1, market internals. The Asbury 6 has turned back to positive as of March the 29th. So Asbury 6, for those who aren't familiar with the Asbury 6, it's one of our tactical models at Asbury Research that we use to determine what the real value, or what the real condition is a better word, the real condition of the stock market is. You can't just look at the S&P 500 in volume or like a MACD or something anymore and get a daily back of the envelope indication of what's going on in the market. So what we did is we back tested my favorite tactical metrics that I've been using throughout my career in different sets of 3, sets of 4, sets of 6. And we wanted to find a group that would do well together, play nice together, so to speak, when 1 or 2 of those were giving you a false signal. The other 4 would pick it up, kind of like a team of indicators. And we came up with the Asbury 6, and only one of them has to do with directly with the price of the S&P. That's the one up top here that I'm pointing to. It's the rate of change in the S&P 500 or SPX. That was on purpose because, again, we're trying to discover what the real health of the market is. The metaphor that I use for this is when you go to the doctor's office, the doctor gets an idea of what your health might be when he watches you walk in the door. Then once he sits you on the table and starts to do that small series of tests like checking your blood pressure, checking your reflexes, listen to your heart and lungs, he may get a totally different indication of what's going on inside under the hood. And that's kind of what this is doing. So you can see right now all 6 of these are green. And if you look at these dates, 329, 324, 331, this is very recent that the Asbury 6 turned back to positive. It had been negative since February the 21st and avoided a lot of the move down. So now we're positive, and you can see our last arrow down here, March the 29th. And you can see what the A6 does pretty well is it catches the tactical tops and bottoms pretty well, like last year, January 14th, April 12th, August 23rd, and then most recently, again, February 21st. And on the bottoms, we had July of last year, October of last year, and then January of this year. So right now, this tells me the internal health of the market is good enough to begin a new tactical move higher. Number 2, the S&P 500, new major uptrend beginning. This is an interesting chart because a lot has happened since January. A lot of tumult since January, a lot of choppiness in the market, and what would probably at first blush be seen as a lot of trendless activity. But look what's happened here. On January 23rd, the S&P 500 moved above its January 22 major downtrend. You can see that in red. Moved above the 200-day moving average, which is a major trend proxy, and it stayed there. We peaked at the February 2nd high at 41.95, and then we came back and did a retest of the breakout, which is very common when you're looking at equity prices. So we came back and retested the 200-day and that trend line on March the 2nd. We had a little bounce, failed. We broke it just for a few days into the March 13th low. and then we rallied back above the 200-day, and then it tested right in between the 200-day and the trend line one more time on March the 24th. So this was negotiation. This was the market trying to determine if this breakout that we made at the end of January, if it was the real deal or if it was just more sideways chop. What happened in the interim is we actually created a pattern in the S&P 500. It's an inverse head and shoulders pattern. It targets a move to 4250, which implies that we are going to break the February 2nd high at 4195. This chart pattern is going to remain valid as long as we stay really above the neckline here, drawn from the March 6th peak. But I'm looking at the 50-day moving average, which is right on top of the neckline, as more of a moving target. It's currently at 4024. So as long as the S&P 500 can stay above the 4024 area, we've got a valid pattern here, and we should look for higher prices. Number 3, ETF asset flows, aggressively moving into large cap technology. And for that, we've got a chart of the Nasdaq 100 here, NDX, since November of last year with its 200-day moving average up top. And the chart on the bottom is the total net assets invested in the Qs on a day-to-day basis during that same period. So some very interesting stuff has happened here. From February 21st to March 13th, these assets move below their 21-day moving average. That's the line in red here. Why 21 days? That's Asbury Research's tactical time period. We move back above the 21-day on March the 14th, one day after we bottomed at the 200-day moving average here in the NDX. And the Qs actually track the NDX. QQQs do. So bottom on March 13th, we get a new trend of monthly expansion on the 14th, which is still intact. The third most important thing to me is note how these assets kind of stopped going higher at 164.3 billion on November the 30th of last year. That was a near-term top. Tried to take out that area again, 164.3 billion on February 2nd. Failed. That was another top. We actually broke through there on March the 21st, right where I'm circling, came back, tested it, and moved higher. The market believes that this $164 billion area is a big deal, that it's important. And the fact that the Nasdaq 100 is a typical market leader and it's showing this kind of strong tactical conviction, I would call it, I think is a really important piece of the market going higher from here. Number 4, standard deviation, emerging market bottom. So here we've got the S&P 500 daily going back to October of 2021. Down here, we have the percentage of NYSE stocks trading one standard deviation above their 40-day moving average. So you can see that this number of stocks got really low, got down to 5% numerous times here since the end of 2021. Note that every single one of them was an important bottom. Even in a bear market, I mean, even in a downtrend here, it picked off some really important tactical bottoms here. So now it appears that we are morphing into an uptrend. So this bottom that we made on March the 10th, I'm looking at with special interest, because that suggests that the rally that we get out of here could be much bigger than the little bounces in a bear market that we got during 2022. Note that it crossed up above its 21-day moving average. This indicator did. Again, the 21-day moving average, our tactical time period. So now that we're above the 21-day, that suggests we have a bottom in the indicator at March 10th. And this, to me, suggests that we could have a very good second quarter. And finally, number 5, seasonality favors a strong April in SPX, or the S&P 500. Seasonality to me is never a primary indicator. I use seasonality to tell me if I've got a headwind or a tailwind within the context of the other analysis that I'm doing, which were the previous 4 charts. So what you see here is that this is quarterly seasonality for the second quarter in the S&P 500. Each of these 13 bars represents one of the weeks in the second quarter. So what you see is in April, the 3 of the 4 strongest weeks of the entire quarter are the first 3 weeks of April. We're in the first week of April now. And even the last week of April is the 7th strongest in the series. Then we start to get a lot more negativity as we go into May and June. But right now, April is a tailwind for the analysis that I just showed you. It suggests that we could have a very good April. So there you have it. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. You can use the contact tab on our website to request additional information. You can also subscribe to Asbury Research's YouTube channel free of charge to get access to more of our work, including our bi-weekly Following the Money podcast. We just did one of these at the end of last week, so that is available now. Thanks for watching. I will see you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.